In this video, we're going to walk through Handout 7-2, which again involves Quickie Grocery acquiring corporate cola, but this time they're going to make an acquisition of more than one bottle on each day, of course at different prices. On January 2nd, we can see that they acquired 8 bottles at $8 a bottle for a total of $64. January 10, 4 bottles at $8.50 a bottle for a total of $34. And Quickie also made acquisitions on January 12, 16, and 25th. They acquired a total of 40 bottles for a cost of $3.67. And again, that $3.67 is going to be capitalized, recorded as inventory, and we're going to match those costs with future revenues. Now we've got to simply figure out how we're going to match the cost, particularly since the bottles were acquired at different prices. We're going to walk through again the 4 different methods: specific identification, FIFO, LIFO, and weighted average. In terms of bottles left over, an inventory count shows that we've got 14 bottles on our shelf at the end of January. That means that we must have sold 26 bottles. That's the 40 we acquired minus the 14 in ending inventory. The first way we're going to assign a cost to those 26 bottles that we have sold is we're going to assume a cost flow assumption of specific identification. If Quickie has kept track of each individual bottle, they can apply the specific identification method. Again, they wouldn't use this for bottles of cola, but we're more likely to use it for automobiles or high volume items that are unique in character. But in any case, let's go ahead. Quickie has sold the bottles it acquired on January 10th, and that was 4 bottles at $8.50 a piece for a total of $34. We sold 10 bottles that we acquired on January 16th, and those cost us $9.50 a piece for a total of $95. And of course, the bottles we acquired on January 12th cost us $10 a piece, or for $120 in total. So our total cost of goods sold will be $249. That means we've got, again, 12 bottles, or rather 14 bottles remaining in ending inventory. 8 of those were acquired on January 2nd for $8, and 6 were acquired on January 12th for $9. Ending inventory will be $118. We take our cost of goods sold of $249, add to it our ending value of $118, and that needs to equal our $367 total cost that we spent to acquire our inventory. Under our FIFO method, we're going to assume that the earliest bottles that we purchased are the first ones we're going to sell. So let's go ahead and do our FIFO calculation. Again, recall we sold 26 bottles. First thing we're going to do is we had purchased 8 bottles on January 2nd, so we'll assume we sold those at a total cost of $64. We will assume we sold all 4 bottles we purchased on January 10th at $8.50 a bottle for a total of $34. We will assume we sold all of the bottles we purchased on January 12th at $9 a bottle. And so far, we've accounted for 18 bottles. So we need to sell 8 of those that we acquired on January 16th. We acquired 10. We will have sold 8 at $9.50 a piece for $76. We add that up, and the total cost that we're going to assign to the 26 bottles we sold is $228. And of course, if our total cost was $367 and we've assigned $228 to cost of goods sold, that means that we've assigned a cost of $139, the difference, to ending inventory. Let's make sure that that's the case. Again, we sold 8 of the bottles that we acquired on January 16th, so that means that 2 remain in ending inventory, and 2 at $9.50 is $19. We've got all 12 of the bottles we acquired on January 25th at a cost of $120 for a total ending value of inventory of $139. And again, our $228 cost of goods sold and ending inventory equal the cost that we spent to acquire our inventory. Let's go ahead and take a look at our LIFO method now. Our LIFO method, recall, assumes we sell the last items in. Those would have been from January 25th and the 16th and so on. Last in are the first out. And again, we've sold 26 bottles. So we will assume we sold all 12 of the bottles from January 25th, 10 of the bottles from January 16th. That brings us up to what, 22? And we're going to need to assume that we've sold 4 of the bottles from January 12th. So our calculations, we've got 12 bottles at $10 a piece, $120, 10 at $9.50, that's $95. And then again, we're assuming we sold 4 of the bottles from January 12th, and 4 times 9 is 36. So our total cost of goods sold will be $251. And then we can calculate the value of ending inventory. And again, that's simply going to be the value of the bottles that are remaining. And we've got 8 bottles at $8 from January 2nd, 4 bottles at $8.50 from January 10th for $34, and of course we still had 2 of the bottles from January 12th at $9 a piece, or $18. We add those up and we get ending inventory of 116. And once again, we want to make sure that that equals our total cost. We take our 251, add to it our 116, and that indeed does give us the $367 in cost that we had to allocate between current sales, that would be cost of goods sold, and inventory, which will be matched with future sales. Our weighted average method is fairly straightforward. Again, we simply take the total cost of all our purchases, which was $367. We divide it by the 40 bottles that we purchased, and we get an average cost per bottle of $9.17.5. Then we calculate cost of goods sold. Recall, we sold 26 bottles, so 26 times $9.17.5 is $238.55. We had 14 in ending inventory, so 14 times the 9.175 gives us 128. We add the two together and we get our total of $367. Again, we want to notice that our choice of inventory method does not change our total cost. We had $367 in allocated cost for the specific identification, $367 for FIFO, $367 for LIFO, and $367 under weighted average. It simply changes our allocation, or how we match cost, with our current sales, and that's through cost of goods sold, and our future sales. Those are the costs that we leave on our balance sheet, and we match with future periods' revenues.